All right. Good morning. Good morning, everybody. So far, so good with QRA. We went sideways, base case held through the day, and we got the proposal, and we're still here. So it's very likely we're going to get the same as what he did last time, which is to say he's just going to continue on with the current system. Now, he took the job from Yellen. Yellen had it before, and he used to complain or criticize about the way she did this. So the expectation was that he would come in and he would change things because, he certainly had a lot to say when somebody else was doing this job about the way it was being done. And now here it is the second time around, and he hasn't changed it. So maybe he's still getting his sea legs, or maybe it's just easier to criticize someone for a job until you actually have the job, and then you got to try to figure out the same thing they were trying to figure out. Doesn't really matter in the end. It seems like we got the same as before. We'll know for sure on Wednesday. So 8:30 in the morning on Wednesday, we'll get the final outcome for QRA, and we'll go from there. The base case held through the overnight. The idea being that we're basically sideways with a lot of data coming in this week. The big Mag 7 names, we've got 4 big ones reporting, 2 on Wednesday, 2 on Thursday. And that alone can be enough to set the market sideways while we wait on that data. But we're also getting job numbers, housing data. There's just a lot of information coming in this week. And to be fair, the market is hungry for information. It's one of the things that I continue to hear over and over is we need more information. Now, most of that is directed towards the administration and the tariffs, but not all of it. We need to know, how much damage did Doge do to employment, those sort of things. So it's more than just the tariffs. The more information the market gets, I think the better off we're going to be. And this is a big week for information. NASDAQ and the Russell with the S&P, everything is flat, right? Now the Dow is up, more than a quarter, less than a half, but it's outpacing its peers. The Dow being the blue chip, the darling, and it has a different weighting than these. Otherwise, most of the market looking around the world is barely up or barely down, really not pushing much edge on one side or the other, waiting on data. So you can see we get a lot of that data today. Most of it's going to be done through the morning. So by the time we get into the afternoon, we're basically done with anything until Globex this evening. Then you'll get a lot of data through Japan, and then into the overnight through China, more Japan, then early tomorrow into Europe. We've seen the dollar making some pretty good moves yesterday, continuing this fade to the downside, holding still underneath $100, but it stopped around 99 and started to come back up again. So we're just holding in this channel. It got uglier before, right? We got down into 98, but at the end of the day, we're still holding underneath that 100 line. And as long as we're staying in this channel and it's not really going anywhere from here, things are okay at this point. Now, we still don't want big sweeping fast moves. Yesterday it started to pick up speed. That caused a little bit of concern, but it slowed down around 100, around 99 and came back in again. But that is the box, 98 to 100, just having the dollar just bouncing around in there. The 10-year continuing to fade back down, nice and easy, right? We don't want this one moving too fast either. And even with this consistent, persistent move to the downside through the week, those 3 days of movement, we didn't really get much of a pullback until now, right there, right? So kind of needed that. Want things to calm down. This is moving to the downside. That hasn't changed yet. And until we get a higher low, a higher high here, get above 4.3, then I think we're just going to keep focusing on this headed to the downside. It would need to break 4.3 and start pushing to the upside, maybe set a higher low at that point. We'd start considering that it's moving back in the other direction. Light volume, again, all things considered, that's usually where our normal was, right? Back in the day, 60s is a good number. It showed a decent amount of liquidity. The only reason we consider that light right now is because we've been running in the hundreds. And so seeing it only at 67 seems a bit light. But, back in the day, that was the norm. And you can see this red line, which is kind of a little built-in average that I have developed. That red line is where we've been running on average, and we're all the way down here, right? So instead of 162, we're running at 67. And that's a visual demonstration of how off we are this morning. I know, right? Back in the day, yeah. Back 100 days, actually, right? Like 105 days ago, because it was just before the inauguration when we started to really pick up in liquidity. Back in the old days. We're still holding around that 0 gamma level, so we still have the expectation that the VIX isn't going to help out all that much. Now, to be fair, in relation to the way the VIX is moving, if we do happen to get a significant breakout and a fast move in the VIX, we could see some influence. But otherwise, we're not going to be seeing that, tit for tat, penny for penny, teeter-totter movement that we were enjoying so fruitfully over the last few weeks. As long as we're this close to that 0 gamma level, then the influence is just not there from the VIX. So we have to go back to what we used to do, which is more of a swag level, lines in the sand, where we say, well, if the VIX gets below this level, or if it gets above that level, then there could be some influence, instead of the literal tick for tick differences that we were playing with. Nothing good can last forever, right? Just had to enjoy it while we had it. We are pressing against that 10-week. So if we can finally get above it, get a close above it on the week, that would be a significant change we haven't seen in a while and would offer us an opportunity to challenge the call wall. Now, if you've been reading the Spot Gamma founders notes and been keeping an eye on their discussions about this structure overhead, they've made it really clear where they think the line in the sand is on the upside. If you haven't been reading them, and I know some of the feedback I get is that, hey, it's complicated and I'm a futures trader and I don't understand options, so I don't read it. I understand the argument or the complaint, right? That maybe you don't understand a lot of what they're saying. Feed it to AI and ask the AI to explain it to you. You can always do that. B, there is some plain English stuff in that founder's note every day where they will use common words like support and resistance, and we don't think it's going to go higher than blah, 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 right? So sure, a lot of it is options talk, but not all of it. And how will you learn if you don't try, right? So it's a very expensive service, doesn't cost you anything, right? I'm giving you the report. Take advantage of it. It will help. And yeah, you can feed PDFs to AI and have the AI read it and then ask it questions. Since we're basically flat on the morning, we are in between the two ADR lines, and we are now IX10. Yesterday, we were just inside day, but we've evolved, and now we're IX10. The markets don't like compression. It's a lot like nature. In nature, if you start to compress things and you don't give it a release valve, it'll blow up. Crazy, right? Same thing in the markets. If you compress it and compress it and compress it and you don't give it a release valve, it'll blow up. So which way is it going to blow? I mean, this doesn't give us any directional output, right? It's not telling us it's going to explode higher or lower. It's just telling us that the longer we stay sideways here, the more likely it is that when the move comes, it's going to be violent. There is an old market adage that says the wider the base, the higher in space. That does imply higher, by the way. But this isn't a base, right? We are at the top of a range, more of a topping pattern than a bottoming pattern. Still, if you use the analogy of the wider the construction of this sideways range, the farther the move can be when we finally get it. You could use something like the RSI Laguerre, check its gamma levels. You could just measure the whole thing and plot it higher and lower. The textbooks would tell you 50% and 100%. So you just measure this entire range. 100% of it to the downside would be that low, and 100% to the upside would be that low. I didn't even have to get any other drawing tools out, right? Like using the fibs or the quadrant lines where you can just add 50%, right? The quadrant lines are these new ones down here. Now I've got those only going in one direction. A, I could just flip the drawing over and have it moving to the other side, or B, I can just add more levels. I'll just flip it over just to save time. 50%, 100%, right? Same thing on the other side, 50%, 100%. Even at 100% of this move, we wouldn't hit, even at 50% of this move, we wouldn't hit the ADR on the upside. The ADRs are set for a 200-point range because that's what we've earned over the last month. In the last few days, we've built this really tight range, and we have to get out of the box now, GTFO, before we have anything else that we can do. We have to get out of this box. And so that's the focus. Until we get out of the box, we're just looking to do kind of like what we did yesterday, expand it a little bit. This starts to develop a little bit of a microphone pattern, right? Where you get this shape like this. Now, we didn't get the lower edge to expand like that, but we did get the upper edge, right? So from yesterday, you can see we broke a little bit there. So that gives us like an upward slant. But on the bottom, we didn't expand lower, right? I actually kept it more of a channel. I would expect that we're going to widen this thing out until we finally break. But it doesn't have to be uniform like a clean textbook megaphone pattern. Those things look really good in the books, right? If you're studying candles and candle patterns, they always look really great. These perfect patterns that are really unrealistic in real world trading, right? Trying to find those great examples can be really difficult. So the expectation is that we can challenge the high that we've set, just like we challenged Friday's high yesterday, or we could challenge the low that we've set, even challenging Friday's low if we need to, because it is a part of this range, Friday and Monday. But the market is waiting on the data that we're looking for this week, and the expectation is that we'll go sideways into it. Is it Wednesday night? Is it Thursday night? I don't know, right? I don't know. I don't think anybody else knows. Nobody can anticipate which one it's going to be. But the market is holding the line, waiting on something. If we do get out of the range, then ADR is the target. That's the very first thing you want to aim for, is the ADR lines. Now, me, I like my 111 and my 1236. So, stair step, I would be focused on that 111 or flipping it the other way, a 111 and a 1236 first before we get there. But you get the idea, right? The longer target would be the red line. Step by step, we would get through that, and then we would move the lines, keep working our way up, or the other way around. If things get really bad, we'll target these yellow lines, but it would have to be something really good or really bad to kick us off and get us going that far. It would have to be shocking and unknown that just hits us, not something that we could have seen coming, which is generally what moves the markets in the wildest ways anyways. It's not something we saw coming. It was something that snuck up on us. We're still well above the weekly expected move, not even within the channel, which is fine with me. If we break Friday's low, we'll be inside the channel. Then we'll have to worry about that Friday pivot, the weekly pivot. Today's floor pivot is higher than yesterday's, not by much, but it is higher, and it's a much narrower channel. A narrow channel implies that if we break out, we can actually run somewhere. Now, these pivots don't make price do anything, but it does give us a glimpse or an idea of what happens if we do break out, that it very well could grow legs and just continue to run. Now, we're looking for a sideways day because we're expecting the market to wait on data. But to be fair, we don't know which data point the market is exactly waiting on. I kind of expect to see hedging in front of whatever the event is, and we don't have the hedging this morning. So maybe it's QRA tomorrow morning. Maybe it's the earnings Wednesday night. My base case argument is it's probably QRA tomorrow morning. That makes the most sense. And if it is, we'll see them starting to hedge somewhere around 3:30, 4 o'clock tomorrow morning. We'll start to see that start to come in. And if we do see the hedging, then we'll know we're right. If not, we should see the hedging late afternoon as we get close to the earnings event. But I don't think it's that. We don't have an MDP because we've already hit it. If we were to turn on the SNR lines, we very likely have already hit R1, which sets us up for an S2. Right? I'm not sure. We could just turn them on and see. Yeah, no, we didn't get to the R1. If we had already got to the R1, then it would have lined us up for an S2, but we haven't got there yet, which implies we're going to do very likely what we did yesterday, just stay within the range. Here's the R1, and there's S1, and we really didn't do much. Very likely we do the same thing today, with the idea that we could very likely wick out outside of it and come back in again. 5,500 was tested, which was also last week's point of control, and so far it held. Now, we don't know how much more is left down here, right? If you consider that something that we have to work through, digest to be able to move through, we don't know how much more is there. So far this week, we've developed a classic D-shaped distribution. Everything's running fine. No surprise on what we have. If we break 5,500, just like we talked about yesterday, it's going to get really shallow. We move through shallow areas relatively fast. On average, that's generally what we do, right? Make big, fast, sweeping moves. Didn't leave any footprints behind, so there's really nothing to catch us and hold us. And the next stopping point would be the next round 100 number, 5,400. So from 55 to 54. Spock Gamma laid it out as like 5250 before they saw any options levels of interest, right? It's a long way down, yo. $10-day TPO and volume profile, 30-minute time frame. We're still holding the point of control, but we are going to be losing these candles throughout the next 2 days. And as we take these candles off the board, this line is going to move. If we stay where we're at, continuing to build out this range, then it's likely going to move up to where we are. That makes sense, right? Because that's where we're at. We're building it out, actively building it out. It could move into this lower zone here. It could, but it very likely wouldn't stay there very long because we're going to be getting into those candles before we get into these candles up here. So it depends on whether we leave the box soon or not. We can see that the TPO has already moved down into that lower point. And it's very likely that TPO moves up to where we are here at this 55.32 cog line soon. So I wouldn't be surprised if we see this red line up here tomorrow. And it's not exactly lining up with the volume profile, but at this point, this profile is a pretty nasty shape, right? If we were thinking about the classic profiles, the P, the B, the D, this looks like chewed bubble gum or something, right? There's no pattern to this. It's just madness. So we want to pick out the high spots, keep track of the value area high and low, structures that we can hit, shallow points that we can fall through, and anticipate where the point of control is going next. All right, we carried forward that point of control from Friday. It wasn't a VPOC, but it was just a POC of interest. And, you know, to be fair, it didn't really have too much value to me throughout the day. I kept it on there, but Friday's close was a better line than this, right? This just really didn't help all that much. But you never know. That's why we put it on there. I'd rather just stick with the VPOCs, and we don't have one at this point. So the last one was 53.16, and I don't think we're going to get to 5,700 anytime soon, but that's another one that we have overhead. Got a really nice distribution this morning on the TPO. The volume profile is a little muddier, a little sloppier, I suppose, another way to say it. And they're not in unison yet. They're close. It's close enough. I wouldn't haggle about it. The distinction on a profile that's within your own trading day are these high volume areas that can become areas of interest. On TradingView, I think they have these quote developing points of control, right? These areas where it's starting to develop a new point of control before it becomes the point of control, which is, I don't know, kind of neat, I guess. If you have TradingView, it's worth checking out some of those more complex profiles. To me, I wouldn't want this on my intraday chart. It's too much noise, but to each their own. So on the high side and the low side, I like to see, did they come in and run any defense? Were they active along those areas? And was it matched on the volume profile with the TPO? That looks like a headline out of Marvel Comics. FBI warns of time traveling hackers. Yeah, that's a new one. So for the week, we're still inside the range. In fact, we're still hovering around Friday's close. We haven't gone anywhere, which makes sense. We've been talking about that, right, through the morning, that we're IX10 at this point. We're sideways. We need to GTFO, get out of the range. Yeah, I kind of figured it was messing with the internal clocks. And of course, they got to get a nice snappy headline like that so that people just can't resist. They have to clickbait. So we are still below the 10-week. We're looking to get that push above. It's very likely we don't keep it the first time round, but it would be nice to, get above it, get a close above it, a nice little stretch, at least where we fade back down. But what we have been dealing with, it's very likely what we're going to continue to see are these crisscrosses, right? Where we're back and forth. We're not really able to keep it, but it's been a long time without us being up there. So kind of due for a little something. Remember, all of this still is just some bullish bias in a bear market. Some of the biggest up moves we've ever seen in the history of the market has happened in bear market conditions, right? So sure, we're making good progress to the upside. Yes, I think the low is in, but that doesn't mean that we can't revisit the low or even get near it, right? Put in a higher low somewhere around like 5,000 again. And the concern is that we'll see 5,000 before we see 58. So, it's a nice run so far, and we got out of the box that we were focused on. The box being this box. We are outside of it for the moment, but unfortunately, that's all we've got, right? Is we got out of the box, and then we stalled. We're just there. We're holding. We're holding. As far as, correction goes, this is a really good digestion or correction, just holding here, maintaining the line. It's healing, it's getting strength. The longer we're here, the better we are. But it does need to hold. We don't want to get back inside this box. And if we start developing a squeeze, then it could really make a move. It's another thing about IX10 is it will eventually develop a squeeze if it lasts long enough. For the 10-day, we are maintaining that sweet spot. We didn't continue to drive to the upside and get above 3. We've already started to work our way back, and we're below 2%. So that's a good thing. Anything more than 0.5% to the upside and less than, say, 2.5 from 2 3/4, we don't really want to get into that 3 area. Then we're just too overbought. So we're in the sweet spot. This is a good place to be above the 10. Kind of hold the line, let the 10 move towards us another 1% or so. So we have time before this move, right? But it's like the old adage, we cannot stay here. We will leave this range. I know that may seem like some Captain Obvious stuff, right? Like, thanks. Yeah, gee, didn't see that coming. But you'd be surprised how often that just escapes people. We're going to leave this range. Guaranteed. But the longer we stay in it, the more violent we're likely to move when we do move. All right, looking at things that are down this morning. Gold miners and China are down. That's really the biggest ones. Chips are down, just not down enough. Same with bonds and energy. They're down, just not down enough. And even the Mag 7 down a little bit, but barely scratching the surface. Flip it around, take a look at the other side. Uranium is up and nat gas is up. Yeah, yay. Everything else is not up enough. Now, I do this morning briefing early, and so we don't exactly cover things closer to the open. You would want a different time frame, right? You would want to use something like maybe things that are up 1% or up 1.5%. So if you're, recreating this morning briefing on your own closer to 9 or 9:15, use 1% or 1.5% for your benchmark, your line in the sand. Since I start at 7:30 and we usually wrap up around 8, 0.5% works just fine for me. We've got nat gas, pot stocks, and uranium. That's not what you want for a rally day in the S&P and the NASDAQ. Now, to be fair, that doesn't mean that we're going to sell off and have a bad day. It's just that these sectors won't give us a bullish push. And if they do, I wouldn't take it. The push is going to have to come from something else. It can be 0-day flows, dealer hedging. It could be a move in the dollar, the 10-year, even moves in the VIX, right? If we get a spike like I was talking about, it could be that. But it won't be the sectors at this point if this is what they have to offer. Even to the downside, these aren't the sectors that would drag us down. So, no, that ain't going to do it either, right? If we look at what's down, we've got energy, China, gold, and it says cloud computing. Usually, if we see cloud computing in the overnight, it's just an algo print, just one little dash. Yeah, that happened at the close yesterday. It didn't happen in the pre-market this morning. So got to be careful with that one when you see it on the watch list, is when did the move happen? It's not reading anything this morning, so it's still reading that after hours move to the downside from last night. So I would discount that one. But you still have gold and miners and crude and China down this morning. But they're not the sectors that can take us out. So watch the clock, keep your eye on the news, check for hedging, looking at the market maker move, and look to hold the line, right? That really is the base case. We expect to hold the line another day while we're waiting on data. IX10. And when we finally leave the range, it should be explosive. Shouldn't be hard to miss when we finally get it. And it should come with news, right? And not surprise news. The market is waiting on this. So it's going to be one of our known news. All right. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.